We're diving over into indicators. Everyone asks this question. Everyone always says, Dek, what are the best indicators to use? Should I be using this moving average? Should I be using the RSI? Should I be using this? Should I be using that? There's so much to choose from. How do we know which ones to use? First thing is, what even is an indicator? What is the point of them? So what are stock indicators? Well, technically indicators are heuristic or mathematical calculations based on price, volume, or open interest of a security or contract used by traders who follow technical analysis. So what we have at this time is these are going to be mathematical calculations that is going to help traders understand where a potential resistance or support line is going to be at. That's all indicators are at the end of the day. At the end of the day, indicators are just going to be telling us and giving us as a trader an idea of where the certain stock that we're looking at is going to reverse. Is it going to bounce off this indicator? Is it going too high and it's going to reverse off this indicator? Well, what are the most popular indicators? Well, let's kind of talk about this a little bit more. Let's say less is more. And what I mean by less is more is we don't want to have too many indicators. This is probably the biggest problem that traders face while starting on off. They put too many indicators and they start saying to themselves, I don't even know what I'm looking at this point. Limit yourself to no more than 3 indicators. Sound good? 3 indicators is your max. If you have 20 indicators on your chart, it's way too much. You're only going to keep second guessing yourself because you're just going to run into another different indicator. So I want to teach you the most popular indicators and teach you about the indicators that I use. The ones that I use are the most popular. They're the ones that are used by every single trader. Now, why do I use the indicators that I use? Because since they are the most popular, that's going to lead towards the stock actually following these indicators. So what does this mean? Well, as we know, people buy a certain stock, it goes on up. If people sell a certain stock, it goes on down. At the end of the day, stocks only go up because people buy them, and people go down because people sell them. So if we can understand what everyone else has on their chart, well, we're going to have a massive advantage because I'm going to know now where everyone else is going to sell or where everyone else is going to buy. And if I know that, well, now I could be ahead of the game. Now I could be ahead of the curve. Now I'm going to have an advantage. If anyone ever comes up to you and says, oh, I know a secret indicator. I know an indicator that no one uses. It's the worst indicator in the world. Because why would we ever want to use an indicator that no one else is using? So you're telling me you have an indicator that no one else uses? So why does it have any power? There is no secret indicators. The best indicators are the most popular indicators because that's where everyone else is buying and selling, which actually influences the stock, which actually leads to you making more money off a predictable manner. So let's talk about the 2 different types of indicators. We have oscillators and we have overlays, okay? So let's start with our overlays here. Overlays are going to be technical indicators that use the same scale as prices that are plotted over the top of the prices on a stock chart. Examples include moving averages and Bollinger Bands. We have our oscillators here, which are technical indicators that oscillate between a local minimum and maximum are plotted above or beneath a chart. Examples of this would be a MACD or an RSI. So you are going to have 2 different indicators. I use 3 overlays and I use about 1 different oscillator. But the thing is, you can use 2 different ones, 3 different ones. Just don't get too ahead of yourself. So let's start with overlays here. Our overlays are going to be what's actually on the chart, actually mixing with the candles of the chart when we're taking a look at our trades. This is what I see when I am looking at, let's go with the S&P 500 and let's show my indicators. You can see that I have this green line, I have this blue line, and I have this red line. These are the different lines that I'm using. Green line, blue line, red line. These are going to be overlays. They're overlaying the candles of the chart and giving me more details about these charts. I'm going to tell you what these 3 are in a second, but I just want to give you an example of showing you what these actually are. Now, moving on, we can see here that we also have our oscillators, which is going to be underneath the chart or sometimes being above the chart. So some people are going to be adding different indicators, and we can just go to our indicator chart here and we could say to ourselves, hey, I want to go ahead and I want to add volume, or I want to add RSI. I can go ahead and add this, and now that RSI is currently under the chart. So it's not overlaid, it's under. So that's the big difference between the two different types of indicators. And I say that I would want every single person maybe having 3 overlays and maybe 1 to 2 oscillators, and that's about it. You don't want to get too crazy because a lot of people do research on what's the best indicators, and before you know it, they are basically turning their charts into just absolute madness and just saying, well, I need all this different stuff here. So much stuff, need it all, need it all, need it all. And you just can't even follow what your chart's telling you. Can anyone read this? Can anyone read this chart right here? This chart makes 0 sense to me. And even if I did say, oh, wow, this is going to be a good chart, I would be second guessing myself 24/7. You have to keep it simple. Simplicity is key. So I want to show you a little bit more about my charts and why I suggest every single trader does the same exact thing that I use. Okay? So let's dive into the first topic right here. The first one is going to be talking about the 50-day and 200-day moving average. Now, what is a moving average? Well, a moving average is a simple and very arithmetic meaning of a certain number of data points. The only difference between a 50-day moving average and a 200-day moving average is, you guessed it, the number of time periods used in the calculation. One uses a 50-day, one uses the 200-day. Now, I know this can sound confusing, where it says the 50-day moving average is calculated by summing up the past 50 points and then dividing it by 50, while the 200-day moving average is calculated by summing the past 200 points and dividing it by the result by 200. You don't need to know any of that. It doesn't matter. Remember, everything I'm teaching is going to be based off psychology. Do you know why I use the 50-day moving average? Well, Dek, you already said everyone else uses the 50-day moving average. Exactly. So that's where we're actually going to be having simple results. For example, if you head on over towards trade ideas, automatically we're going to get this blue line. This blue line is the 50-day moving average. The red line is the 200-day moving average. If I go over to www.stockcharts.com and I type in SPY, what comes on up? The blue line, which is the 50-day moving average, and the red line, which is the 200-day moving average. If I go to www.finviz.com and I click any sort of stock, let's just click POLA, guess what comes up automatically? In the orange is the 50-day moving average, and in the yellow is the 200-day moving average. What am I trying to get through here? Every single default chart is going to have either the 50-day moving average or the 200-day moving average coming on up. And that means everyone sees it. So if everyone sees it, that's where people are always going to be saying to themselves, hey, get ready for a nice little reversal around this area. Hey, get ready for this stock to, pop on up and then start dropping itself back on down. We could probably go through some of these plays here. And I know even yesterday, there's a lot of plays that ran on up towards their moving averages that usually get rejected. So for instance, if I want to take a look at right here, most likely we're going to see rejection. We're going to hit the 50-day moving average, and we're probably going to start seeing some selling, just like we saw on the last one, where we hit the 50-day moving average, and we're probably going to see some sort of rejection. We're going to see some sort of falling. We're going to see some sort of fading on down. Yesterday, I believe that's the whole entire reason why we looked for our trade, UFAB. Like, look at this play. UFAB, notice this play usually runs on up, hits its 200-day moving average, gets rejected. Runs on up, gets rejected. Even this blue line right here. Look at the blue line, the 50-day moving average. If you don't get a massive spike, it usually hits the blue line, falls back on down. Usually hits the blue line, falls back on down. Usually hits the blue line, falls back on down. This is just going to give us an amazing area that we constantly know, hey, it's time to sell, or we know it's time to get a bounce play. So we could see the MINM holding up at the 200-day moving average. KLXE right here. KLXE is going to hit the 50-day moving average, then probably start falling back on down. Notice JAGX hits the 50-day, hits the 50-day, hits the 50-day, then starts falling on down. We can go through all these examples. We could see, where did this breakout start happening? Breakout started happening at the break of the 50-day moving average. So do not be a person that says, ooh, I'm using a 1.78 moving average. No one in the world is using that. You want to know where breakouts happen? At breaks of indicators. You want to know where most reversals come back on down? When we run up to them and then we get rejected. So if we have the 50-day moving average, or we have the 200-day moving average, and let's say we have this example. The blue is always going to be 50-day moving average. The red is going to be the 200-day moving average. This now tells me if this is a stock right here, if it spikes, get ready to sell and lock in profits, or get ready to short as it hits the 50-day moving average. If it spikes, get ready to sell, lock in profits, or start getting ready for shorts at the 50-day moving average. If it spikes and breaks the 50-day moving average, get ready for a very nice spike, especially if there's a 200-day moving average nearby. It's most likely going to run up here, and that's where it's going to start selling itself on off. Just like when we take a look at, right here, hits the 50-day moving average, falls on down, hits the 50-day moving average, falls on down, hits the 50-day moving average, falls on down, gets a break, nice spike, room to run up towards around that 466 mark. UFAB from yesterday, almost the same exact thing. On a normal day, UFAB usually spikes on up towards the blue line, then gets a sell off, blue line, then gets a sell off, blue line, then gets a sell off, breaks the blue line, runs on up towards the 200-day moving average. And you can do this every single day looking at different examples on, how high a stock can run. And this isn't even the examples I have in the chart. This is just examples from today where you could, even if you want to, you can go ahead and type in, Tesla if you want to. Tesla, notice, guess what's happening? Aren't we bouncing off the 50-day moving average? Bounce right here and bounce right here. And we keep getting rejected as we come up to the 200-day moving average. You can take a look over on Amazon. Is it weird that when we take a look over on Amazon right here, traders, that we hit this red line, then we got this big rejection, and we hit this red line right here, and we got this big rejection. And now since we're breaking the red line, we're starting to get a breakout. I hope this is opening up your eyes and being able to say to yourself, wow, so when we break these popular indicators, everyone usually sells at these popular indicators. And 9 out of 10 times when we hit these popular indicators, we usually do get a sell-off. But the 1 out of 10 times that we break these indicators, we usually see a very nice spike. Exactly. So when we come up towards these red resistance lines or these blue resistance lines, I usually do a short every single time because I know the majority of traders want to see breakouts. But for me, you come up to the red line, do a short, do a red line, do a short, red line, do a short. You'll be able to make money nearly every single time. At 1 out of 5, 1 out of 10, you will get the breakout where you start moving towards the upside. And that's going to be great because you're going to get a lot of buying momentum. But most of the time you can just go ahead and look for some very nice shorting opportunities. But these are all great dip buys and bounce play areas. So let's keep talking about indicators because I think this is a very interesting topic here. So we only use them on the daily chart. This is another big thing that I think a lot of new traders mess up on. I'm going to show you something right now on why we only use them on a daily chart. So if we take a look over, let's go back to Amazon here. Let's say, why do I only use it over on the daily chart? Well, because on the daily chart is going to be one of the most popular charts. Nearly everyone trades with a daily chart. Always a daily chart on with their minute chart. But I want to ask you guys something. What would happen if I added a 50-day moving average right here? Let's go to SMA. Let's change this to 50 and let's go to add. Anyone that's using a 1-minute time frame at this time is going to say, hey guys, get ready. We're going to have a bounce play off the price of 111.80. All right, awesome. But what if someone's not in on a 1-minute time frame? What if someone's in on a 3-minute time frame? They're saying to themselves, 1.8, what are you talking about? The dip buy is actually at the price of 111.47 right now, 111.50, not 111.80. Then someone else is going to say on a 10-minute time frame, says you guys are idiots. You guys are nuts. What are you guys talking about? The dip buy is back on down towards 110.80, not 111.80, not 111.50, but 110.80. So the thing is, what are we starting to realize? We're realizing that if we keep it on the daily chart, 99 out of 100 people are going to see the daily chart and going to follow the daily chart. But some people are going to say, oh, the bounce is going to be here. Some people are going to say, no, the bounce is going to be down here. Some people are going to say, no, the bounce is going to be all the way back on down here. And that's going to change and basically give weakness. If there's 100 people in the stock market, nearly all of them, 95 of them are always going to be watching a daily chart. But only 15 of them could be in a 1-minute time frame. And maybe 30 of them are going to be in a 30-minute time frame. Maybe 10 of them are in a 2-minute time frame. Maybe 5 of them are in a 5-minute time frame. So the thing is, with less numbers, there's less strength. So you are going to have less of a chance of seeing a bounce play at the area that you believe a bounce play is going to be coming on up. So I'm just going to skip ahead right here. And I'm going to tell you that the 50-day moving average, the 200-day moving average, and the last indicator, 13 EMA, I only use on the daily chart. That's it. Because I don't want to be jumping around from time frame to time frame trying to figure out, what's the best one. So I don't use that whatsoever. So I'm going to be honest with you. The only indicator that I use on the minute chart is going to be what? The VWAP. Because the VWAP is going to slightly move, and that's it. So we just saw how we just got a ton of dispersion depending on what time frame we were in on Amazon. Amazon's VWAP is right next to the price of 111.60. You're in the 1 minute time frame, 111.60. You're in the 2 minute time frame, it's at 111.60. You're in a 3 minute time frame, it's at 111.55. You're in a 5 minute time frame, it's at 111.55. Notice what's happening here. We had a 50-day moving average. We had $1 difference. Imagine jumping in thinking there's support and it's really $1 difference away. On the VWAP, doesn't matter what time frame you're in. Should be only a few cents no matter what time frame you're in. Just like, you take a look at the chart right here. 1 minute time frame. We could say to ourselves, hey, that 411.50 mark seems like it's going to be a good dip buy. 411.50, where we had a dip buy here and a dip buy here, and most likely another great dip buy here. Remember, the whole point of indicators is just going to be telling us when we're considered bullish, when we're considered bearish, and when a reversal is going to happen. A reversal towards the upside or a reversal towards the downside. And that's what all these indicators are really all about, trying to show us when a stock is considered bullish and when a stock is going to be considered bearish. So when we take a look over on the SPY, anything underneath the VWAP, there's a better chance of seeing the stock fall. Anything above the VWAP, there's a better chance of seeing a stock rise. Let's think about this for a second here, traders, because let's start breaking this on down. We know if I show up every morning and I close my eyes and I click buy, what are my chances of winning? You can be the worst stock trader in the world. You still have a 50-50 chance. You're the worst stock trader in the world. You buy or sell. It's either going to go up or it's going to go down. You got a 50-50 chance. But what if I know that, hey, you know what? I'm going to get a dip buy at a certain area. Well, that could bring us up towards maybe around a 60-40. And what if I say to myself, hey, the S&P 500 is underneath the VWAP. Underneath the VWAP, that's showing us bearishness. Well, that's going to be 70-30. And now again, we're coming on down towards the 200-day moving average. This should be a nice dip buy and bounce play. Well, this could make us 80-20. So essentially what we're looking for and what we're trying to do is get off a 50-50. We can close our eyes, do a spin in our chair, randomly click a buy button, and you know what? A stock is either going to go up or going to go down. That's it. But now we can start understanding, are we bullish? Are we bearish? Where's support? Where's resistance? Where is everyone else going to buy? Where is everyone else going to sell? We're creeping our way on up with more reward and less risk. And that's how we start putting the odds in our favor. So how do I put the odds in my favor? Well, I look at chart setups. I look at volume. I look at float. I look at the indicators. I look at, are we bullish? Are we bearish? I look at the RSI. I look at the MACD. I like to make sure that every trade we make, we have a better chance of winning than losing. So let's keep diving in on this. Let's start understanding this even more here, traders. So what do we have here? 50-day moving average and 200-day moving average. Simple moving averages, SMA, are often viewed as low risk areas to place transactions since they correspond to the average price that all traders have paid over a given time frame. The 200-day moving average represents the average price over the past 40 weeks, which is used to suggest a relative cheap price compared to the price range over the past year. Use only on the daily chart. And as you guys can see already, we do have the 50-day moving average. Every time we hit that 50-day moving average, notice what we have. We have bounce play right here. Boom. We start moving on up. Bounce play right here. Boom. We start moving on up. Resistance right here. Boom. We start moving on down. Resistance right here. We start moving on down. You can see how awesome these look, right? And whenever we hit resistance, 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 we get a big time breakout. We go back underneath it. It holds up as resistance. So it really just comes on down to really understanding the fact that this is just another resistance and support line. You don't got to say, hey, Dek, what are the calculations to figuring out 200-day moving average? You don't need to do any of that. It's just all one big psychological number. And the reason why we use the 50-day and 200-day moving average is because it is the most popular. There's no such thing as a super secret indicator. So 200-day moving average, same thing. Top resistance, top resistance, top resistance, top resistance, breaks it. Now it's bottom support, bottom support, bottom support, breaks it, top resistance, 200-day moving average. So you want to be understanding this. Dek got it. 50-day, 200-day. What about the green line? The green line is the exponential moving average. The exponential moving average is a type of moving average that places a greater weight and significance on the most recent data points. This exponential moving average is also referred to as the exponential weighted moving average. An exponential weighted moving average reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. I know, sounds confusing. Guys, you don't need to know any of it. It doesn't matter. So what does matter? Well, the 13 and the 20 are the most popular moving averages when it comes to exponential moving averages. This is one of those lines I only use on the daily chart because it will change depending on what time frame you're in. And really the name that you guys can give this is the flexible trend line. So the flexible trend line. Well, let's kind of do a quick little recap on what is a trend line. Just like when I told you before, we want to know if a stock is bullish or bearish. So wouldn't it make sense when we have a trend line, basically this plank going across the stock, anything on the top side of this stock is considered bullish. Anything on the bottom side is bearish. That makes sense, right? Well, yep, it goes on up when it's above it, and when it's underneath it, it goes on down. Absolutely. When it's above this orange line, it goes up. When it's underneath it, it goes on down. When it's above this orange line, it's a bullish. When it goes underneath it, it's bearish, and it goes on down. Beautiful. Let's go ahead and take a look over on the S&P 500 and just as an example, and let's turn off everything other than the 13 EMA. Let's go to indicators. Let's turn off the 200-day moving average. We don't need it. Let's turn off the 50-day moving average. We don't need it. And let's just use the 13 EMA. Now, the 13 EMA is absolutely incredible for long-term investments, okay? So long-term investments, it's very helpful. It helps you on out and be able to understand when we are considered bullish or when we're considered bearish. So let's just take a screenshot of this. And it's going to help us know for swing trades if we should keep holding or not. So we know that whenever we are underneath this green line, there is more bearishness than bullishness. So if I see that we crack underneath this green line way up here, and we just say to ourselves, hey, I'm going to hold this as long as we hold the 13 EMA. Bearish, 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 bearish. Look at this big drop. And you don't got to get scared. You don't got to get feared out of a potential play. As long as it holds underneath the 13 EMA, you are going to be considered bearish. Now, we did get a little period, as you guys can see right here, we got a period of consolidation where it wasn't super clear on which way it's going to go. But then guess what? We started getting a nice drop. And we're bearish, 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 bearish. And you can literally hold during this entire period right here because it's underneath the 13 EMA. And then we break the 13 EMA. And notice we are bullish, 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 bullish. And you could hold the S&P 500 on your option contracts or whatever as long as you were above the 13 EMA. And then guess what happens? We go underneath the 13 EMA. And as long as we are underneath the 13 EMA, we are considered, as you know, bearish. So you don't got to get scared out by one green day. You don't got to get scared out by one red day. As long as you follow the trend, you will be good to go. Hey, Dek, I don't know how long to hold on to the S&P 500. Well, as long as it holds the 13 EMA, you are considered bullish. Well, Dek, I don't know how long to hold my put contract. As long as it holds underneath the 13 EMA, you are going to be considered bearish. It basically just tells us when the S&P 500 or whatever stock that we like is considered bullish or when we are considered, as you can see, bearish at the time. So the S&P 500 at this exact moment is basically in a little consolidation phase, but I would say we are a little bit more bullish at this time than bearish at this time. So I basically give it the nickname of the flexible trend line. It tells me when I should be bullish or when I should be bearish. That Tesla, as long as we're above the green line, we are bullish. Whenever we're underneath the green line, it's bearish. And now that's giving me a great idea of which way I should be leaning towards every single day, trying to break away from 50-50s. If I see that I'm way above the 13 EMA, hey, let me get ready for a possible call contract or a long entry. Now it's going to be 60-40 because I already know there's more buyers, so I can be going on the call side or the buying side. The odds are already in my favor. So now I'm putting the odds in my favor just by looking at the 13 EMA. Then on top of that, I do have the 200-day moving average that I like. All right, so we have our SMA, we have our 50, right? 50-day moving average. And then on top of that, we also have our indicators right here, which is going to be our 200-day moving average SMA. So 200, change this over to red, boom, add, boom. And now we have our three indicators showing us where support, resistance is at and showing us if we're currently bullish or bearish at this time. So that's all I have over on my daily chart. Okay, that's all I have over on my daily chart as in overlays. Now let's move on to the next sector, which is going to be our oscillators, of course. So let's go into some different indicators as well that I think is important. RSI. RSI, it's easy, it's simple, and it works. It's easy and simple, and it works. Relative strength index. The relative strength index, RSI, is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought and oversold conditions in the price of a stock of other assets. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. This is something that I personally only use in the daily chart because depending on what time frame you're in, you're going to get a ton of different answers, and I would rather use what everyone else is using, which is the most popular. So, how does this work? This is one of my favorites. It's very good, and it's a great way to be able to know when to swing trade and when not to swing trade. So let's go over to stockcharts.com and let's just type in a couple different plays. I just want to find like a nice, easy, good one for us. Let's just go with Netflix. So I'm going to take a screenshot off of Netflix, and this is what we have. This is where we're at this moment. All we have to look at is you can see that there's a big group of numbers from 0 to 100, or what you can see from 10 to 90. All you need to do at this time is say to yourself, all right, here's a 30. Here's a 70. Anything that is 70 or higher is considered overbought. If it is underneath a 30, it is oversold. So what does this mean? What it means is exactly how it sounds. A stock is overbought. Would you ever buy a stock that is overbought, which means people bought it so much it's going to come down very soon? No, you wouldn't ever want to buy that stock. Would you ever buy a stock that's oversold? A stock that people have been dumping on off, and now it's at a great price. That's a dip buy. Yes, you would want to buy it. You wouldn't want to sell a stock that's oversold. You'd want to buy a stock that's oversold. You want to sell a stock that's overbought. So all we have to do is look at the RSI. The RSI shows us when we should sell and when we should buy. So for instance, I can see that at this point right here, we are next to a 70. If we're next to a 70, I know that there's going to be sellers coming in the near future. Scroll on down to this exact price point, and guess what happened the next 2 days? We had a nice sell-off. You can also see we came up near a 70 right here. And guess what happened? Over the next few days, we had a nice sell-off. Now, you can also see it happen right here, where we were overbought with a 70 or higher. We had a nice sell-off. Here's another area where we're near a 70 on the RSI. And guess what happened? We had this monster drop. But notice where we got. We got such a big drop that we came all the way on down near a 30 on the RSI. If we have all the way down near a 30 on the RSI, well, now we're oversold. So people see this as a dip buying opportunity, which now leads to a very nice spike. And now, since we just had a very nice spike, now we're considered back up near a 70. And if we're back up near a 70, now we're overbought, which is where we start getting a very nice drop. So what you guys can do at all times is say whenever a stock is overbought, yes, remember, we're going back to the 50-50. When a stock is overbought, we know that it's going to most likely drop. When a stock is oversold, we know it's most likely going to climb. Hey, do we have 50-50s at this point? No, we have 70-30s because we know the direction that the stock's going to be moving in the near future. Now, this does not work always on penny stocks because penny stocks may not be good, credible companies. But when we're talking about solid blue chip Fortune 500 companies, yes, this will work. So that's how a lot of people know when to swing, know how long to swing until we go from 70 to 30, 30 to 70. So you can see when we are oversold, the stock moves on up. And when we're overbought, we move on down. When we're oversold, we go on up. When we're overbought, we go on down. When we're oversold, we go on up. When we're overbought, we go on down. So the RSI is an absolutely beautiful thing that just shows us exactly what we need to be doing. When we are overbought, guess what? We have massive collapses all the way back on down. But the same rules apply when we are even oversold. Oversold, watch your buying volume. Oversold right here, right? Watch your buying volume. You can see oversold, watch your buying volume. Every time we have an oversold move, you usually start getting buying volume. When you're overbought, you see the same exact thing here. So let's talk about another oscillator that is extremely important that a lot of traders like, and that's going to be the MACD indicator. So let's go back over to stockcharts.com. This one's very simple and very easy, and you don't have to use all of these, but try to find which one you like the best or which one works the best for you. And when you take a look over, let's say over on Netflix, we'll just stick with Netflix, we can take a look at the MACD. The MACD is these squiggly lines down here. Very simple, very easy. Really what it comes on down to is black line is going to be bulls. So the bulls are going to be in control. Red line is going to be bears. Okay, so when you see a red line, the bears are going to be in control. So what does this show us? It's whoever is on top. Okay? If you ever think about wrestling, if someone is on top, they have control. Whoever is on the bottom is struggling. So if I see that at this moment, let's just take a look from here to here, we have the black line on top of the red. Notice that's also when Netflix is climbing its way on up. Now we know when to sell. Not only because we know that the RSI is near 70, but we can also see the reversal from the red line over the black line, which is also showing that this is where a sell-off is happening. So we have now a 30 on the RSI. We have a big dump, and we also see that the bears are starting to give up to the bulls, and we're starting to see another reversal. A reversal from sellers to buyers. And now the bulls are in control because the black line is on top. Now the black line's on top, and that starts switching on over. And as that switches on over, we can see that this is giving us the answer. We can also see we're near a 70 on the RSI. So these two things are going hand in hand. So we have now, when we think about it, we have our 200-day moving average. We have our 50-day moving average. We are going to be having our 13 EMA. We are going to have our MACD, and we're going to have our RSI. Now, I know there are some people that are saying to themselves at this moment, Dek, it can't be this easy. It can't be this simple. Can it? Can it really be this simple? And I'm going to be honest with you. 99% of the time, this is going to work great. There will be times that you will see a stock go from a 70 on the RSI, you short it, and it goes up to a 75 on the RSI or 80 on the RSI. That happens. But at some point, it will come crashing on down. Now, the opposite way, well, Dek, what if a stock has a 30 on the RSI or a 29 or a 28? You just need to be aware that a lot of these plays, make sure it's a good, credible company. If it's a penny stock, penny stocks don't need to bounce back on up. They might be going out of business. But on good, credible blue chip companies, this will work the majority of the time. Now, if you're saying, hey, Dek, I'm a shorter, or I like to do put contracts. Can I just wait until stocks become extremely overbought and then just go ahead and short them right back on down? Hello, ding, ding, ding. This is how I made over $500,000, right? This is how I had one of my biggest years. Guess what I did every single day? I went to finviz.com. I click screener right here. I go to all. I go to RSI. What's overbought with a 90 or higher? AQST, BGI, BLRX. Get ready for some shorts, guys. So I can go on over right here. I can say AQST. I find that play. Yep, over a 90 on the RSI. Probably going to be a nice short in the near future. BGI, this play right here. $8 to $10. $10 top resistance. Probably going to be a nice short. BLRX. BLRX has gone from $1 to $166. Probably going to be a nice short. All great shorting opportunities. If you want to kind of do it a little bit different, you can go, okay, I want to look for stocks that are overbought, but that are also moving up today, or I want to do stocks that are overbought that are moving down today. They're overbought and they're starting to turn back on down. So overbought, starting to turn back on down. These are all stocks, as you guys can see, that just had very big spikes and are now starting to have red candles. These are all stocks that are now starting to spike and now starting to turn its way back on down. Very big spikes starting to reverse. So we're not buying into momentum. We're actually starting to try to catch these tops as they start turning. That's another way to be able to do this. So what else do we have here? We already discussed this indicator, but we do have the VWAP indicator. And the VWAP is the only indicator that I use on the 1, 2, 3, and 5 minute time frame. And really the VWAP is just going to be telling me when a stock is bullish and when a stock is bearish. Whenever we are above the VWAP, I always lean towards a little bit more buying. Whenever we're underneath the VWAP, I always lean towards a little bit more shorting or put contracts. And we always know that it's going to be a great support or resistance line where we bounce off the VWAP or crack back underneath the VWAP. As we know, why are these the best indicators? Think about it, they're the most popular. The most popular equals the most strength. As we have the most strength, they are the ones that work out the most for us. There are many other indicators out there. all these different Bollinger Bands and scholastics and average directional index and all other moving averages and these Akumi clouds and parabolic stops and reverses. And there's all these different indicators out there. I use what's most popular because I see the market as one big psychological game. If I can get into the head of the majority of traders, guess what? I'm going to know where the majority of traders are going to buy and where the majority of traders are going to sell. And if I know where they're going to buy and sell and be able to reverse a play, I know where I can make money. If I can buy in where it bounces, where I can short where a reversal is going to be, that's where we can make lots of cash. So remember, what indicators do we use? Daily chart, 50-day moving average, 200-day moving average, 13 EMA. Above it, the RSI. Underneath it, the MACD. Then on top of that, the only one we use on the minute chart is going to be the VWAP. The VWAP only one because it doesn't change based off time value. Everything else does change based off time value, so it will not give you the most accuracy. Ladies and gentlemen, take this lesson right now. Absolutely crush your trading in the future with it. And I want to make sure every single person comes out on top.